Hey, everybody. Today in the show, we have a really rare guest, someone who has actually started his own bank. Now, as Sam will tell you, it's really hard to start your own bank. It hasn't happened very often in the last few decades, but we're going to hear the story about that. So, Sam Morris, welcome to the show.
Hey, thanks for having me, Jonathan. Really appreciate it, bud.
So just tell me, like, and really give me this snapshot of what you do right now, and then we'll kind of get into the backstory.
Absolutely. So my name's Sam Morris. I'm CEO of a company called Sunset Capital. And so we are owners and asset managers of apartment complexes and storage complexes. And so that's really where our main focus lies. And been doing that now full time since 2018. Sunset's newer company. We started that about 2 years ago when I had a split from my last group. And so that's what we've been doing kind of full time the last 2 years. And then, I do a lot of other things. I'm a reformed corporate banker. So I was a banker for 18 years prior to getting into real estate full time. And so I currently sit on the board of directors as a founding director for Texas Traditions Bank here in Katy, Texas.
Awesome. Well, you have an amazing amount of experience across a whole bunch of different aspects of the real estate business. But what I really want to talk to you about is the banking issue, because it's just very rare that we get a banker on. And so not just to talk about like the story about how you started this bank, but also love to get some of your insights about what's going on in banking right now with respect to real estate. So why don't we just start off with the story about how you started the bank and like why you took that challenge on?
Yeah, so it's kind of something that I had been doing for a long time prior to getting into real estate. We had helped establish and start new community banks, so smaller banks, right? Which is what our bank is. And so, a couple of years ago, back in 2018, we sold our last bank, and a lot of the guys who I'd worked with while we were there, even at that time, we were talking about, hey, it'd really be great to do this again. In the future. And after some years had passed, we had started talking about it again. And really, it's more about the people, just like almost with any kind of business, right? It's the right people. And so we have a great CEO and a great president who really just have taken this by the horns and said they were going to own this. And so we developed a board of people around them, and then it's really it's our BRR, right? It's probably the easiest way to say that, right? Because it's a lot of the same shareholders. We go out to a lot of local shareholders in the community. And because of the expertise that we had with us, we started what's called a de novo bank. De novo just means from zero, right? And that is kind of a rarity to actually get your charter and start a de novo bank. We were the 57th, I think, granted charter, probably in the last 10 years for the whole country. And so it's not a common thing to get de novo charters. It's becoming more and more, I think, open to it because we've had so much consolidation in the market. So many small banks have gone away. And I think there's actually a great need for community banks almost, nationally, because they serve just a great purpose for local communities, not just for real estate, but for all types of businesses. And it was one of those things where we had a desire to really reinvest back into our community. It was something we knew how to do, and we knew how to put the money together, how to put the teams together, and we had the people that could do it. And so it was one of those things that kind of naturally evolved right back into starting a Texas Traditions Bank. So I'm really glad to get to sit on the board. I'm honored to get to be able to do that, and it's been a blast so far because we've now had the bank open for a little over a year. We're profitable. Which is also a rarity to be profitable so quickly. But it's really because we've surrounded ourselves with just great team members. So the bank is really made up of wonderful people.
So let me ask you just a really basic question. Like when you start a bank, right? I mean, how do you got to have money, right? I mean, you've got to have some money to start lending out to make money. How do you actually get the money? Is this just a traditional kind of like go and raise money like you would for any other company? Or like just talk about that sort of stuff? Like how do you actually get the initial funds?
Yeah, so it's kind of funny, right? So as a syndicator, right, we raise money for real estate. So let's say we go out and we need to raise $6 million for this piece of real estate, whatever the number may be. It's actually kind of similar. We literally went to mom and pops all around us and said, hey, we're starting a local community bank. we'd love for you guys to come be a part of it, right? And we're going to raise, in this case, about $38 million. And that'll be enough for us to have the seed capital to start the bank. So,
and so does that money become like the initial deposits of the bank? Is that,
yeah.
so when you go to,
Yeah, but yes, it's capital. I mean, so that's money that can be lent. That's money that can, that's money that could be anything for the bank, right? It's, it could be invested. It could be, it could be our initial deposits. It could be our initial loans, right? It's actually part of the bank. It helps us with building out our locations and things of that nature. It helps us with hiring the right people. But the deposits, most people don't realize, I mean, the deposits, and particularly for small banks, that is the lifeblood of the bank, right? You have to have the deposits to be able to lend them back out in the community and make money on it. And it's that arbitrage that we really make. That's how banks make their money, right? I mean, they're very highly leveraged businesses. Banks are much more so than real estate. So
I mean, it's, the old, like, in the old days, it was what, borrow at 3, lend at 6, golf at 3, like, is it still essentially the same model? I mean, I know it's probably work a little harder now, but
but I mean, realistically, it's not too far off, right? From the standpoint of, banks are risk managers, right? They're managing risk of their own balance sheets. And so when they put a loan out, there's a lot of things that occur with that, right? You could be giving a loan to, and pick your poison, whoever it is. Let's just say it was an apartment complex, right? Depending on where that apartment complex could be located, right? There's some benefits associated with that. This loan that you just made on a commercial basis to an individual could be supporting now a couple hundred families, and it could be in areas where, where maybe there's not a lot of investment into that area. And so there's what they call CRA, or low to moderate income type stuff. And so there's a lot of reasons why you would do something like that. And it's good for the bank. It's good for the community. This is how you revitalize those areas. I mean, you go back years and years ago with large institutions would come and buy up those small banks. I mean, if you have, say, a very small town, let's just say there's one bank there, right? You take that bank out of that small town, the small town will eventually go away, because it's what's the means for commerce, right? Because, here's Jonathan and he needs to go fix his truck. So he goes and borrows, $500 from the bank to be able to pay the mechanic to fix the truck. That mechanic's got to buy parts. He's got to pay the labor. He's got to do all, that's how commerce occurs. And that's why banking is such a vital institution to really our way of life. And so you can tell I'm passionate about it. I love banking. I think it's a great industry. And I think it's one that's heavily needed, in particular the smaller community banks.
And so when you raised the capital, the 38 million, I think you said, for the bank to start off with. So how did you then get deposits? Like, did those initial investors also, did they agree to deposit some of their savings into the bank also to help capitalize it? Or
so it's funny, right? So this is not a new formula of way we've done this before, right? You now have probably, in this case, about 400 walking billboards, right? And those are your first customers too, because they obviously believe it enough to invest into it. But remember, I was saying we have great people, right? We have great bankers that are on staff, and a lot of them have a great, huge following of people who want to bank with that individual. The sign on the door could actually change, but it's a people business. It's a relationship business. They want to invest with that person. That banker is one who's helped them with their business or helped them with whatever situations they have, and they bank with a banker, not necessarily a bank. And so it's a very distinguishing thing to say, yeah, I have a banker versus I have a bank, because one can actually, you can call on the phone and direct line to that banker and they can get things done for you. A bank is a whole nother thing. I mean, that's an institution, right? And so that's kind of one of the really separating factors between, I think, our bank and a lot of other institutions, right? Is, if you come to our bank, you get a banker, you don't necessarily get a bank, if that makes sense. You get both, really, but you get a banker, which is a big difference and a big key.
I mean, it's funny, like, actually, so I'm in New York City, and there aren't really a lot of there are some smaller banks in New York City, but for the most part, everybody's doing their banking with one of these like mega banks, right? And you don't have a banker here, right? You just have a bank. If you're really wealthy, you get to have a banker, but if you're just like an average schmo, you don't get to have a, even an average schmo business owner, right? You might have somebody who's called a business relationship banker, but those people are getting transferred every 3 months to some other place, or they're moving on to another bank, and you never really develop a relationship with any of them. So like the idea of like a small town bank where you actually like know your banker and they know your problems, and like you can call them up and say, hey, Sam, I got this problem. How can I work this out? It's very appealing, to have
For
that kind of thing.
sure.
Yeah.
Well, I mean, and think about it too, right? I mean, and I would tell you it suited me really well in real estate, because I've lent well over, call it $1 billion on different types of real estate, right? Across all CRE. I've seen hundreds, if not thousands, of partnerships and how they all have worked out, what they've done, decisions they've made, whether they be good or not so good, right? If something has occurred, how it was handled, right? Or how it was inappropriately handled, or how it was handled too really well. And so you learn a lot of aspects of how to do things right, or how really to avoid doing things wrong. And so one of the great things about having been a banker for almost 2 decades was, I was exposed to all kinds of deals, in all kinds of scenarios. And so there's not many things that I can say at this point that I haven't seen, on the real estate side, just because, we've been in it for a couple of decades now, right? And so you get your battle scars, from watching a lot of others too, right? And so the other beauty of it too, and I do tell people this too, is lending, like real estate, it has its own vocabulary. So the bank world has its own vocabulary like real estate does. And so, they talk a little bit differently than these guys talk, or the way normal people talk, right? When you and I were, if you and I were to talk and we start talking about things like, we start bringing in all the acronyms, the IRRs, whatever you want to talk about, right? We inherently know what that means. And in the banking world, they have that too. And so it's been of a great benefit being in real estate, having the ability to speak that language with our lending partners as well.
And when you started the bank, so you got your sort of your capital, your initial deposits, who are the people that you need to hire to get this thing off the ground? Like, what's the kind of basic staffing of a new bank?
Yeah, it's a lot, but internally, I mean, there's a lot of departments, and so I can tell you, we started with 28 individuals, no resumes, because we knew them all, right? We worked with them all. And so that's kind of a big thing. And that's part of the reason why we were probably able to fast track it a lot for us as well, too, because everybody worked with everybody else. Everybody knew what the plan was, how to do it almost inherently, because they've been doing it for so long. And so a little bit different, right? Because we already kind of had all the horses to pull the trailer, so to speak. But there's a slew of things that go on even outside of all of that, right? So I mean, I can tell you there's just a ton of different operational things that you have to have within the bank itself. Compliance and all kinds of things are really big right now. Loan ops, treasury, you have, not just lending and, all that aspect too. There's a lot of other aspects to it that you have to have set up. You have to have a lot of third-party vendors. We have great partners though that had already done this with us previously. So it was, kind of like, remembering to ride that bike, right? And so having a lot of those third-party vendor relationships already established, things of that nature, regulatory body relationships established, all those things are already really kind of helpful to be able to accomplish that.
And how difficult was it actually to get your charter, like to start a bank from scratch? How long did it take from the time you actually sort of hit go to when you actually were in business?
Well, I mean, I would say it was at least a year. It takes a while, right? There's just a lot of things that have to occur with all of that, and there's just a lot of moving parts as well. And even then too, you have to make sure you're hitting certain metrics. You have to make sure you're your budgets look appropriate. You have to have your plans, your policies in place, and things like that. I mean, when I say we've got great people in the bank, I really can't stress that enough, how great the people that we have in the bank. And I mean, and that I personally have worked with for long periods of time too. So that, you know, I have great trust in the people that are working there because we've worked together for a long time, right? Many of them well in excess of 10 years. So, and in banking, and them doing the job that they're doing for us right now. And so, this isn't like we went out and hired a whole bunch of ad hoc groups. This was a group we had already all worked with together. Everybody had all worked with one another. And so it was really easy to go, all right, come on, we're going to start this.
As you mentioned before, that I think you said you're the 57th bank or so to be chartered in the last decade.
I'm a de novo, yeah.
De novo, yeah. Why is it so difficult to get new banks off the ground?
Personally, if I were to say, I mean, I'll just say it this way. I think the regulatory bodies are actually, very eager to see, in particular small communities serviced. I think maybe the FDIC isn't as eager to see new banks get started when they have to do insurance for all of it as well. So the FDIC could be a roadblock for a lot of people, but if your plan really isn't really ideal for the community that you're going to be serving, it's pretty much not going to be something that goes off, because you can even have all the capital you need. If you don't have the right people and the plan associated with how you're going to service the community that you're going to be there to service, it's going to be very difficult for people to get a new charter. A lot of people will, really what's I would say the way most new banks have started is that they've gone out and acquired some kind of bank and then either moved the charter or put the charter where they wanted it to be. And that's how they were able to kind of circumvent all of that regulatory process.
So that's an easier thing to do, to sort of assume an existing charter than to try to get a charter?
I think it's much easier to do, but I think it's also much more costly. I mean, for the capital that we raised, I think we did a very good job, and we were being very prudent and fiscally responsible by starting it new the way we did, because I think our shareholders are going to benefit from it.
And one last sort of mundane question on this, on the starting a bank, did you, for your physical location, did you like buy an existing bank and take over the bank itself, or did you build a new bank? Or
no, we did. Actually, we built out some space in an office, and so and it goes kind of with our premise and our thesis, right? So the bank is a people, right? It's a group, and so I would rather hire somebody that was really good, a banker that had a great following, and build a location around that person, right? Because people are going to bank with that person. You could sit there, that's a big bank model, right? We want to be on Main and Main, or we want to be, these high trafficked areas. The thing is, if you're a relationship group, the people are going to come and they're going to come bank with that banker. And so they're going to come bank with those people, right? And so you're more of a destination spot. Now, that being said, we have a pretty good location with where we are. And it's very accessible for, a lot of the city and almost everywhere in the community. So both from a employment standpoint and a customer standpoint.
So I would like to, I could probably ask you a lot more questions about this, but we will run out of time eventually if I do. So I want to, get to some of the other topics I wanted to cover with you. So, obviously a big thing that's been in the news in the last, 6 months or so was we had a couple of, high profile bank collapses. And I think that the issue there is a little bit like esoteric, and people may not quite understand exactly what happened with those banks. So if you don't mind, I'd love to kind of have you kind of give an overview of why those banks collapse, and
Sure.
Maybe if they could have done something differently, or if they really had, they really were not able to avoid the situation. So yeah, just sort of tell us, like, really simply, what was the problem
Yeah, so I mean, I would actually boil it down to what happened with interest rates, right? And so the way, and this is, I'll, since you're, attorney too, I'll preface this disclaimer. This is just my opinion, right? But, um, you know, there was a modern day run on SVB, right? And the money went out like that, right? It's not like it was in the olden days where there'd be a line of people out the door, with their checkbooks ready to kind of get money out of the bank. It digitally left. And the problem was the way that they had their balance sheet. So every bank, like I said, they manage risk, which includes their own personal balance sheet. And it had nothing to do with bad loans. That's the other misnomer. They didn't have bad loans. Um, Really what they had done is, at a time, they had gotten so much cash in, so much of their deposits were related to, and specifically of SVB, were related to venture capital firms, had huge dollar deposits, right? Well, the bank took that money and said, well, we need to have yield on this money. We can't just let it sit here, right? Because we're, in some cases, we're having to pay them some money on this. So we have to invest it to be able to make some yields, make some spread on that money. And what they chose to do, thinking that they were going to have this money for a really long time, they bought treasury bonds long term at really low rates. Really not a wise move to do, because money comes and goes real easy. They thought that these were going to be really like sticky deposits and stay for forever kind of thing. And when they did that, they bought at a low of the market, right? They bought a long-term bond at a low rate. Well, obviously what happened in the last year and a half now is rates shot up, and when rates shoot up, bond values actually go down. And so the value of that investment portfolio that they had went down, and it went down so much that it went down more than their even capital position. Now, normally, if you just hold the bonds till they mature, no big deal, no harm, no foul. But it was so long out there. And when they had started having demands on their deposits, meaning people wanting their money back, they were being forced to sell those bonds at losses to be able to cover the deposits. And then it happened so fast that they became insolvent. And unfortunately, the regulators had to take the bank over.
So that's a pretty clear explanation of what happened at SVB. And was that essentially the same situation at Republic and
yeah, so there were many banks across the country that had their investment portfolios, and it's really an accounting thing, because everything, a lot of people will say that their investment portfolio they hold, it's always for sale, meaning you have to do a mark to market, meaning they have to show the true value of the bond as it is of that day, right? And so if I invested in a 2-year treasury, right, and it was, when I bought it, it was 3%, thinking I was getting 3%, what a great deal. Well, the par value of that bond is now less, because now it's paying 5, right? And so I have a mark-to-market loss if I had to sell that today, right? And what the government did back in March, or at least what the Treasury did, was they made funds available to banks, right, to effectively borrow that missing liquidity. They were able to borrow up to their lost capabilities and to shore up the banking system by doing that. And so that's why really you haven't heard much about it since then, is because the banks that needed the liquidity to shore their balance sheets up were able to go get it from the Treasury window.
And so was this avoidable, or was this, those banks that failed, did they do something that was unusual, or is this kind of what all the banks were doing because this was the wisdom as to what you should be doing in that moment?
It was somewhat, I would tell you, it would be avoidable, but it was somewhat how they were set up, right? I wouldn't say SVB was a bad bank, right? But the way they were set up, they catered to a specific clientele, right? That specific clientele made up a major portion of their depository source. And when I say major, I mean, I want to say it was like 85% of their accounts were above FDIC limits, meaning 85% of your money is above the $250,000 insurable limit. That's a big, big number, and much larger than what most other banks have. In addition to that, there's something called ALCO, which is Asset Liability Committee. The ALCO committee is effectively the group that manages the balance sheet of the bank. And so they'll decide, hey, we think we should make investments into this, or hey, we think we should charge this kind of interest rate for these types of loans. and make sure that we're managing the risk of our own balance sheet. And so it's really important that people on that committee have banking experience, understand what a balance sheet is, understand what risks are. And so, their board makeup maybe didn't have all the things that they probably needed to have. And there were a lot of red flags that obviously were, potentially ignored. I mean, there'll be case studies on this stuff for probably years to come, but there's definitely some things that were avoidable. But part of it could be the way that they had their business structured.
I mean, I was just wondering, for instance, why was it that they thought those deposits were so sticky and there wouldn't be any, demand to withdraw those deposits? Is that seems to me something that might have been like a mistake that they made, as opposed to something that everybody was doing, right?
Sure. Yeah, and for me, what that would signal to somebody who sits on the ALCO committee is like, hey, if we have deposits that are transactional accounts, and we have so much of this, I'm not saying you can't go invest the money, but maybe don't go out 30 years, right? Maybe go 3 months or something much shorter to where you have access to that capital really quickly, or losses that would be very limited if you had to sell real quick to access that capital. And so there's just a lot of things like that logically would tell you you would go through that way. But some of that's also playing Monday morning quarterback, right? You see it now versus what they were making that decision on at that time. So they clearly saw things differently than what we're seeing today.
And what, I guess sort of along those lines, this is a real kind of lay person's question, right? Because I'm not a banker, so, but the I would, so I like, the traditional kind of like It's a Wonderful Life version of like banking, right? Like, like your money is in Joe's house and your money is in, and so those are really like long-term like instruments, right? If you're mortgage, if you're lending somebody a mortgage, right? So why is that, like, if the issue with SVB was that like, hey, the stuff that they were investing in was too long term, why wouldn't like mortgages also, like, why would they ever be lending mortgages, I guess is what I'm just trying to understand.
Sure,
right?
sure.
Yeah. And is it maybe
right? It's same kind of thing. You still have to manage a certain amount of risk based upon those transactional accounts, what you have, and things of that nature, right? Because what a lot of people don't realize is that mortgages can be sold. Any loan actually can be sold. I mean, you created an instrument when you did that loan, and now you actually have a piece of paper that you can sell that has intrinsic value to certain people, right? The good thing about treasuries is they're really instant, right? Highly liquid when you're able to do something like that. But it was the decision of how long we think we're going to have all this stuff, right? And so your investment account, almost always you're going to want to put money into loans versus the investment side of it, right? So realistically, if all the money was lent out 30-year paper, which it wouldn't be, because your committee would sit there and go, we're going to manage our duration risk too, right? And that really what it was they didn't manage their duration risk associated with the investment portfolio side. That's the risk that's in that, but it's also the yield for it too, right? Your yield on a mortgage, 30-year mortgage today, I mean, it's north of 7%, right? Whereas a 30-year treasury is far less than that. And the delta being that there's risk associated with putting that money out. And so are you willing to take the risk for that money that you're going to have to put into it, right? And so there's always, the banks aren't going to ever have enough cash at that location to cover everybody. They're just not, because they put it out into the community, like what we talk about. That's part of their investment strategy too, right? Is they're going to invest in those areas. The difference being is they're making bets on, say, a hotel. I'm going to go lend money on a hotel. I may give you, if you're going to buy a hotel for $10 million, a bank's going to sit there and go, all right, well, I may be the biggest partner, but I'm only going to give you $6 million. You're going to have to come up with the rest, right? But I'm going to get preferential treatment. I get paid first on everything, guys. And so that's why banks are willing to take some of those risks. And it doesn't always work out, but that's really why you have duration risk, you have all kinds of different risks when you're doing deals. And the design of a bank is to put money out that way. It's not necessarily to sit there and hold on to it. Definitely not to hold on to it long term that way.
And so looking at SVB and Republic and stuff, and then sort of taking that out broader, are there more banks out there that are in this kind of precarious situation that we're just not hearing about? Or do you think that it was fairly contained to just the banks that, did have a crisis?
Unfortunately, there was a lot of banks that are in this type of situation now. It hasn't, they've got kind of their lifeline from Treasury, where they had the ability to shore up their own balance sheets. But I don't think it was to the extent where you had, it was all your capital kind of thing. You would lose all your capital that you had in the bank. Effectively, your bank be really zero. But it was fairly prevalent, right? I mean, the interest rates affected everybody that way.
So I guess was the issue with SVB really that they just had a run? Like people, their depositors got scared and they had a run. Like you mentioned before, if there had been no run, the treasuries would have just matured and paid back, and they would have been fine.
I mean, they'd still probably be in a negative. They'd still probably be in a poor liquidity situation, and they'd probably have regulators all over them, trying to help them shore up more of their own balance sheet. But they probably would have been okay. Yeah, if their deposits didn't leave, they'd be fine because they wouldn't have had to sell.
They wouldn't have had to sell, right? So they could have just held the bonds to maturity. So I guess that leads me to the question of, so given that the government stepped in and made this, these lines of credit essentially available to the banks to shore up their balance sheets, did that then basically stop the runs on the other banks? Like everybody just realized like their banks were not going to collapse.
Yeah, it was already limited in scope, but other banks were sitting there going like, we're fine, guys. You want to, but remember, like I said, they had such a large percentage of their balance sheet, of their deposits, were these VC and private equity groups that had just massive dollar amounts, right? And so if you looked at where because you can see where money flows, a lot of the money flowed right back into big banks. So a lot of the larger banks were, they were great benefactors of all of this. And so because people went to where they thought they could trust, that the bank was safe, kind of thing.
So taking that situation now, looking at sort of like the lending environment for real estate. I mean, I think everybody who's even tangentially in the business knows that it's a lot harder to get a loan than it was, 6 months ago, or last year. And I would love for you to talk a little bit about why that is. Why is it that banks have become so? I'll let you talk about it before I start imposing like what I think on you. I'll ask you questions when you're done. But why are banks not lending the way they were?
Yeah, I mean, it's risk, right? There have been some things that have changed in the market where it's impacted values, right? And so if you look at things, and it's not necessarily, all encompassing nationally, because there are going to always be pockets that are still really good and pockets that are even worse. And they can actually be really close to each other in the same state or things like that, even in the same market, right? But you look at things that have happened, like interest rates going up, right? The bank's cost of funds now has increased, right? And so if the cost of funds increase, they model out all this stuff the way, any good syndicator would, and go, all right, well, cost of funds have gone up. And so, before where I was charging you 4.5%, it's now 6.5%. And the cash flow for that property has to be able to cover that, plus whatever additional coverage we need, right? And if it's not hitting that, we're going to lower the amount that we'll be willing to lend to you to cover what we think is appropriate, right? In addition to that, banks are not dumb. Most of these guys are really smart. They see what's going on with, insurance. They see what's going on with tightening labor and labor costs and all the costs associated. And they have access to all the same metrics that we do, right? And probably even more so because they pay for information, right? So they see costs are going up nationally in the apartment world by 8.5%, right? That's across the board, and that's that's far greater than inflation is right now. And that obviously that's centered in a few different things. They see that insurance across the board has gone up over 16% nationally, right? And obviously that's not an equally yoked thing, right? Because coastal communities, Florida, Texas, things like that, where it's been substantially higher than that, there's additional risk associated with it. So they are risk managers, right? First, because before they put a dollar at risk, they want to know, one, first thing is they're going to get repaid, and two, what kind of return are they going to get for that money? Because remember, they can invest right now in overnight funds at 5+%, right? And so if they can go make 5% risk free, for them to take on risk, there's got to be a premium associated with that, and they have costs and overhead and things of that nature. So they really got to see, is this a deal worth doing, right? Is there going to be additional business made from it? Things like that. They're taking in a lot more information before they do a deal, which is why, one, it's taking probably longer to do deals, and two, it's harder to do deals.
Yeah, I mean, clearly it's not just the math, right? Because if it were just the math, I mean, they would just total up all the expenses and spit out a number, and if the number works, then you get the loan. But it seems like there's more to it going on than that, right? I mean, what are the other factors that are kind of making the banks more risk averse these days, or less able to lend?
Well, I mean, is this somebody who's going to be able to consummate the deal? They're going to be able to do the things that they say they're going to do. So the character of that person, right? And is there going to be other opportunities that we'd want to put the capital into this versus something into that? And is the balance sheet that we have, let's say we're lenders, and we're getting all these office building requests. Well, maybe that's not something that we want to take that kind of risk on right now, or the premium even to take the risk on it would outstrips what we feel the risk is right now. And so it gets down to even sectors of the type of real estate. It gets down to the person who's actually going to be carrying out the work for them. It gets down to their own balance sheet, right? Because you can have a bank over here that goes, hey, we really want to do hotel deals, right? And these three over here, like, we're full up. We can't do any hotel deals. And the irony is, this fourth bank over here realizes nobody else is doing this around me. Therefore, I can get an even bigger premium because I'm the only girl at the ball, kind of thing.
Yeah. So another question I have for you is sort of, these bankers had on, we've seen a lot of high profile foreclosures recently, right? And during the heady times, we had all kinds of new syndicators entering the business, doing big deals, cobbling together GP teams of like 20, 30 people, and somebody else signed on the guarantees, and, all the stuff. As long as the market was going up and up and up, like, nobody really seemed to care that much. But now that that's all changed, and we've seen, some high profile foreclosures, and probably a lot more in the pipeline that we've yet to hear about, do you think that even when banks go back to lending more freely, once we kind of settle around a new equilibrium and they're comfortable, do you think that they're going to kind of look a little more closely at who the people are that they're lending to than they were, say, 2021?
Yeah, I mean, I actually think the banks do that. They should be doing that as a matter of prudence even now. But as Buffett said, he had a line said, when the tide goes out, you see who's been skinny dipping, right?
Yeah.
And so right now I think we're still kind of even at the forefront of it, where distress really is just entering into the market. Even though we've had some foreclosures, even locally down here in Houston, for the last several months, but you're seeing more and more stress being added to the assets with like the aforementioned expenses I was talking about, with insurance and taxes and things of that nature that are really putting stressors on NOI and being somewhat value destroyers because of that too. So right now I think you got a whole bunch of operators who are deciding, look, operations has got to get back to the basics, and we got to really start cutting costs so that we can maintain or try to improve NOI, because cost of capital is where it's going. And I think you're going to still see some more some more stress coming into the market because you're going to have deals that are maturing. You're going to have notes that are ballooning, and you're going to start seeing cap rates expiring, or rate caps, excuse me, expiring, and it changes some of the dynamics of those deals that are out there.
And when do you think that the lending environment is going to loosen up? Like what will it take for that to happen?
Well, so a lot of that is a function of capital and liquidity, even within the banks, and so I think it's going to be more of when there is a sense that we maybe are through some of that distress, and then from there you'll probably see really good risk-adjusted, risk-based returns that the bank's trying to get based upon their own lending standards. And so I think it's really funny because I sit there and be like, yeah, I mean, it makes sense to me that they're doing 60 or 65% LTVs. And really, we were doing this over a year ago where we were just backing into debt coverage ratios because we knew that's really where the dollar amount should be. And we probably were a little early doing it, but we just knew what the lending environment was either going to be going into or was. And so, I think that's why you're starting to see less transaction volume and things like that, because the capital for that aspect of it is not there right now. And so there may be a lot of liquidity on the side, right? Like what people are discussing, right? But the leverage aspect of that has not gotten there, and still needs to keep, has to catch up. And I think it's probably a ways away still. So, people, we talk interest rates and things like that. We actually had a long meeting about it last night. And, after the pause, I'm probably one of the few real estate guys out there that say we probably shouldn't have paused yesterday, right? As much as I hate rates going up, we probably still have a little ways to go. And it looks like it may be, a quarter point, depending on, what economist you believe right now. But it also doesn't look like there's going to be any kind of drop until, late next year. And it'll be minor at that, right? So, I mean, with what we're going into or what we're in, depending on how you look at it, I still think we've got, I will say this too. I'm probably one of the few people that will tell you that I think the Fed's actually done a pretty amazing job. My goodness, they've halted what could really have been just a terrible recession. And we really are that slow recession looks like it could be reality. We still have a strong economy, relatively speaking. GDP, I think Bloomberg said it would probably be around 2% for this year. It's projected a little less than 1% next year, but that's still growth, right? I mean, the labor market, as tight as it is, I mean, I'll tell you what, the Fed just got a huge challenge ahead of them still. And I actually think they've been dealing with it pretty gracefully. So
yeah, I happen to agree with you actually on that I think they were dealt a tough
minority. I can tell you that right now.
They were dealt a tough hand, and I think they've done pretty well with the cards they were dealt, and can't really fault them. So, well, last question I want to ask before we have to go is sort of how long? What's the internal banking world scuttlebutt about how long people think it's going to take till we kind of reach a new equilibrium and the banks are comfortable with lending more aggressively again?
Yeah, I mean, part of it I think is a function of interest rates when we discuss it. And I always tell people, I mean, if you know where interest rates are going, we should, we'll have this conversation on your own island somewhere, because I mean, if you know it, the markets that well, but at least what we've talked about more internally and with other banking groups, it's been more of a, we think rates are going to drop sometime Q3, even Q4 next year. And that really will be when you start to see some things start to maybe loosen up, right? And there'll be, those people that have liquidity, they may want to start lending again. I mean, there's going to be people that got to put money to work, and you hear about it all the time. There's, like I said, there's so much money on the sides. I've even had a few conversations with people earlier in the year about, unlevered IRR, and going, wow, you guys have that much cash that you're talking about just not doing leverage, and they'll get into it when they feel that will come back. And so, but I mean, personally, I think it's probably Q4 next year. So we got a ways to go, right? But in the meantime, I do think there are going to be some distressed opportunities that could be attractive if you're able to go ahead and consummate those deals. So,
well, on that exciting note of bargains to be had,
there will be, yeah, I do think there will be.
Yeah, I agree with you on that as well. But we do have to wrap it up, unfortunately. But I would love to have you back in, like about 3 months or so, and see how things have changed. What the banking world is looking like at that point. It'd be an interesting conversation to kind of just periodically dip back into every few months. So
it changes, that's for sure.
I'm sure it does, moment to moment. But Sam, really, this has been really, really fun. I really appreciate your time today. And I know you got a lot on your plate, so I really appreciate you taking some time to educate us on these issues.
Absolutely, Jonathan. Hey, bud, thanks for having me on. Really appreciate it, man.
Absolutely. And if people want to get in touch with you, what's the best way for them to do that?
Yeah, I mean, easiest way is to go to our website, which is sunset-capital.com. You can read about our company there. You can see, kind of the deals that we're doing, and then you can join our platform, and either myself or somebody on the team will reach out to you. And so it's a great thing. You get on our platform too. We put out monthly newsletters, and we actually let our investor base actually ask a lot of the questions, and so that's actually ends up being what we kind of write about too. So they get to dictate what the information they want to know about. So.
That's a smart marketing plan, and great opportunity for you folks to ask questions of people who really know what they're doing. So by all means, go to Sunset Capital and check them out. And Sam, once again, thanks for your time today.
Thanks, Jonathan. I appreciate it, bud.